For 3 years, gold has been one of my top ideas for the year, the beginning of 23, 24, and 2025. And it's been on a heck of a tear. But I'm wondering whether it might be time to put some hedges on. We're going to talk a little bit about that today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. Gold. This is a difficult one because I don't really like the idea of pairing winning trades until they start to break down, and I don't know that this one has started to do that yet. But I think it's worth noting that it's looking a little extended to me. Let's just take a look at a couple things here. I did actually happen to, because I'm not a technical analyst, I did happen to go and ask somebody who is. I did ask Carter Worth, who, by the way, is going to be on Open Mic on Wednesday. So if you have questions for Carter, then be sure to tune in. That'll be 4:15 Eastern Time Wednesday right here. So this is a long-term, this is a 30-year chart. If you're looking at this chart of gold, you'll notice that I actually made the chart gold colored. You'll notice that this is a logarithmic chart. And so that makes this perhaps a little bit harder to make out just how sharp this is. But so the pink line here is effectively the 150-day moving average. And I just happen to observe that it just seems like it's getting the gold itself is quite high above the 150-day. Maybe only a few times in the last 30 years has it gotten this far above its longer-term moving average. We can look at it other ways too. So this is a 5-year chart. This one is not logarithmic, but you can see how that would make it seem a little bit different. But I thought it is important to look at something. If you're looking really long-term in gold, you kind of have to look at it logarithmically because the dollar has been debased over that time, and so looking at it logarithmically sort of helps extract that element from it. Otherwise, it's just going to look like it's going up like a hockey stick. In fact, actually, we can look at that too. So if we look at gold long term, this will not have the snazzy gold background because this is going to go to whatever the default is here. If I go to the max is probably not that helpful because we were on the gold standard, so gold was stable. Then there was essentially the reset during the FDR years when he just decided to devalue the dollar by whatever it was, 70% or so. But if we go back to, say, 1967, this should give us a sense. Now, I vaguely recall this spike in gold. I was too young, frankly, to really know much of what was going on, but I do remember conversations going on about it in our house. My father's older brother was speculating in the gold markets at that time. I kind of remember something about that. There was something else also, which was that, in those days, my father had an office, and in that office they had a dark room. It was a medical office, and they had to develop a lot of film. And precious metal prices had accelerated so sharply that it became worthwhile to try to recapture the silver that was used in some of the chemicals used to develop film. That I remember a gift that my parents had given us kids, which was a silver harvester. So you would use this device and try to recapture some of the silver back out of the developing chemicals. This feels to me like we're seeing this is, again, this is not a logarithmic chart, so it seems much more pronounced. But if we take a look in here, we can see that, you know, the price of gold went from, let's see here, 115 bucks an ounce, ultimately up to 700 or so, it looks like, according to this, $700 an ounce. I think actually this is quarterly. I vaguely recall that it actually hit 800. More recently, you know, we are seeing a move from 1,000 to 4,000. So this is a move of sort of comparable magnitude almost. To get that same move off of these lows ahead of time. So we'll just call that 800 and we'll call it 115. So that was like a 7-fold increase. You'd still need to see gold go up by another 80% here. But it is steep and uncorrected is the term that my friend Carter Worth, I think, would use if he was looking at this. So my thinking was that maybe it might make sense to, if one has some of this, to consider at least doing a little bit of hedging. Now, under normal circumstances, if you're looking to hedge equities with something like a collar, because of skew, and we'll just look at, because we're going to be looking at ETFs in the Options Play app, if you're using a collar on equities, and I've talked about this dynamic on a couple occasions, you have skew that looks like this. So if this is the at-the-money options, there's sort of not quite a smile, but what we call a smirk, right? So a smirk meaning that it's asymmetric, but the downside puts are trading at a higher implied volatility than spot is. That's 100. Upside calls are still trading a discount, but eventually you start to see it sort of tail back up again. But in commodities, you often get a slightly different dynamic. And, oops, it did not like that. So let's start over. Go like this. I'll use the same expiration. We get something that looks, instead, like this. And, you know, this does set up an interesting opportunity, arguably, because you can put on a 10% collar, so give yourself still another 10% worth of upside and 10% worth of downside protection at terms that might be less favorable if we were looking at it from an equity perspective. So let's take a look at that. So I'm just going to, again, I'll look at SPY first. We'll look at a 10% 3-month collar, or 3-month-ish. So we'll just go out to January, let's say. We'll go to January regular way. We'll use 663 as our price, so that's going to get us the 597 puts. Something close to it. We'll just use the 595s, close enough. And we'll use the 730 calls again. That's probably close enough. So sell call, buy put. You end up with something like this. Okay, so you're going to pay $491 over 663. You're going to pay about 74 basis points of spot to have that trade on. It's actually not that bad. And, you know, that might well be worth it too, because I think one of the things we've seen, and we're going to get to this as well, is that Friday's action and what we saw over the weekend and today, you know, I think that hedging is probably something that's worth talking about in equities too. So we're going to get to that right afterwards. But that actually wouldn't be a bad trade. You know, sell at 10% out of the money call, buy at 10% out of the money put. Cost you 74 basis points in SPY. And 74 basis points, you know, can you absorb a 10% decline in SPY? Well, presumably if you're long, you can, because we're up more than that. So you'd be locking in gains, and you still have material upside potential Maybe a put spread collar would also be a potential trade there. But let's take a look at gold now. We're going to go through the same exercise. If you happen to have, say, for example, GLD. And again, we're going to just go up and down 10%. Hard not to give yourself at least 10% worth of upside here, given how steep this move is. So we get the 340 puts. It's down about 10%. And the 416s, we'll call it. 416 calls. We have the 415s, good enough. Okay. So here you can sort of see what this looks like. And now you're going to observe that this gives you 10% upside, insurance below 10% downside, and you get paid to have it on. Let's just call it $3 versus $3.78. So now you're going to collect close to 80 basis points. So in one case, you're going to pay 74, 75 basis points to get insurance below 10 and still have 10% worth of upside. In the other case, you're going to get paid 80 basis points. And that's just because of the skew. And look, do I think central banks are going to go on a selling spree for gold? No, they're in accumulation mode. You know, a lot of people are attributing some of this incremental demand now to things like stable coins backed by gold. So I think that's also something for us to remember. But when you have anything that's this steep and uncorrected, there's probably going to be some folks that eventually start asking themselves, well, wait a minute, is there a chance that this could turn around? We haven't had that really ugly commodity pattern, which I've talked about on a couple occasions, which is opening sharply higher, moving to all-time highs, and then closing sharply, sharply lower. In fact, what was interesting is that as all risk assets sold off last Friday as sharply as they did, and what you saw during the week didn't even begin to tell the tale. This is actually a chart I should show you as well, because I thought this was quite interesting. I was looking at the Nikkei futures, because the Nikkei futures actually traded. These things saw a 7.4% decline from Friday's intraday high to the post-close lows thereafter. And this was less than 24 hours. So I'll just chart this out really quickly. So this move right here, 7.7, and that was in a span of 28 hours. Okay, but it was 7.4 in about 22 hours is what I saw. That's a 5 sigma move. That is a huge move, really unusual. And I have said this on this channel a couple of times, that one of the things that I observed when I went through the tech wreck, so from the late 90s into 2000, was that in the latter stages of that market, one of the things I observed was we would get to new highs, but we'd have these breathtaking price jumps and gaps. That volatility started going up even as prices went up. And this is something I think we want to keep our eye on. There's just a couple things going on that just feel a little bit unhealthy to me. 5 sigma moves in the Nikkei inside of 24 hours, that feels unhealthy. We traded 114 different stocks on Friday, 3.7 million contracts. 88% of those stocks were lower, and they were lower by an average of 5.2%. 65% of the stocks we traded were down more than the S&P was, and those were down by an average of 6.4%. So this is, and these statistics I was looking at these statistics on Friday, and they are very fresh to me even now, because that's just not really healthy price action. Now, we did have those kinds. We did have some choppiness well before the March 2000 peak. So I'm not saying that's where we're at, and the valuations are not quite there yet. But you take these things, together, and you start to say, well, there's a couple things that make one a little bit uneasy, right? So we do have above average valuations. We do have rising volatility along with rising prices. There was this big disconnect in gold and other risk assets on Friday. Gold sometimes seen as a risk haven, but gold itself is in this steep and uncorrected mode. And so I think it would probably be a little bit greedy to ask for too much more out of it before the end of the year. Could it go higher? Sure. But do you need to give yourself a whole lot more than 10% worth of upside? I mean, you can in both the S&P and in gold at this point, you can collar these things out to January. In either case, you will have then locked in gains for the year. You'll have locked in gains. I'm not going to say that 10% downside protection is, it's great protection. On the S&P, maybe you want to use a put spread if you prefer that. So if you're more concerned about the first 10%, which is down to correction territory rather than bear market territory, an at-the-money 10% put spread versus an upside short call, I think that's also fine. You would, at the very least, even if you did get to formal bear market territory. Again, I'm not suggesting that's going to happen by the end of the year, but I'm just pointing out that it's an interesting set of sort of price actions that I'm seeing sort of across the spectrum, and I think it deserves attention. Okay, so I think we've kind of touched on the broad topics that I thought were important to discuss. So maybe we can move on to some of your thoughts and questions. If you have any, feel free to pop them in the chat. Joseph Kamen, happy Monday, Mike. Heck of a taco trade today. Yes, indeed. I think this serves as a reminder just how much, I actually confirmed over the weekend that I had a Truth Social account. I mean, I don't log on to Truth Social and I'm not monitoring it. I'm actually not logged on to it now. It's just forced to have it. It's one of these things. But I really should. Because it's pretty clear that these are things that can really move markets. And if you do nothing else but follow the president on Truth Social, you're probably doing yourself a favor. Because if you see a huge move like this, I'm now thinking that that's the very first place I'm going to look. Rather than saying, oh, what just happened? To go and take a look at what's going on in his social media accounts. Because, wow, does it move things. And it was looking awfully, awfully ugly if we didn't get more news coming from that exact same account over the weekend, which we did. I'm trying to remember exactly what he said. Maybe we can find it. I think it was something, don't worry about China, if I can see if I can find that. This is, if anybody happens to have I need to sign in, I guess. So, yeah, I mean, you can see this is not something I have typically used, but if you're involved in the markets, I don't think you cannot watch this at this point. Because it just has the ability to move markets so profoundly. How many posts has he stuck out here lately? Obviously, the news about the release of the hostages in Israel is today's big focus. Here it is. This is the post I was talking about. Don't worry about China. It will all be fine. Highly respected President Xi just had a bad moment. He doesn't want depression for his country, and neither do I. The USA wants to help China, not hurt it. All right. That's literally, that's a 150 handle post in the S&P right there. Because frankly, the way we closed on Friday and how the everything was trading after the close because things continued much lower. You know, it was interesting. I was talking to the head trader during the day on Friday as we were kind of taking a look at things going into the close. Very experienced guy, more experienced than me. He's been at this longer than I have. And he said, I think it's a buy off the 50-day, which was, we can actually take a look at this. He was talking about the S&P, by the way. So let's change this moving averages so that just so we don't have to look at anything but the 50. And he was saying on Friday, I think we'll hit it on Monday because we were just above it off the lows. We actually did hit it after the close. It literally basically hit there, and that pretty much marked the bottom, the 50-day. You know, this is where folks would buy the dip. That was his thinking. And I remember he then sent me a message after a little bit further on saying I didn't expect to have that happen after hours, but we're there. But wow, was that a good point to step in? And then the post came shortly thereafter. So that actually is another interesting thing just to think about, which is, do you think that the news is going to break the trend or not? It doesn't matter why it works, only that it does. If people are looking at this and they think, okay, this is an opportunity to step in and buy the dip, you know, there is significant cash on the sidelines. You know, some people might be looking to get things on sale or whatever. Another important point. But that actually goes back to the whole idea of collaring these positions, because if you do that, it just gives you some dry powder. It gives you some confidence to, you know, make those kinds of determinations and not feel like you're going to be taking obscene risk if a wild Friday in October, all-time highs, suddenly turns into a Black Monday kind of thing. And if you have something like a collar on for at least a portion of your position, then you can add to this. It was interesting also because I was talking to Carter about a strategy we're looking to launch that has very steady returns. And one of the primes was asking us about how much leverage, you know, we deploy. And, you know, our strategy doesn't really have leverage. It's an unleveraged strategy. Not really my style to deploy a lot of it. There's nothing wrong with it for those that manage their affairs with tight stops and close risk management. But I did say, you know, in the outside I could see maybe something up to, rarely, Reg T levels of margin. That is to say that if you find yourself in a circumstance where you think that the underlying assets really have gone too far and you want to capitalize on the ability to add a little bit at significantly depressed prices or sell something short if you really feel like it's significantly overextended. You know, this is just another way to sort of think about that. You can, if you're the type that takes a lot of risk, then you can use leverage to affect these things. If you're not so inclined, then putting hedges on. And look, this is the chart right here for the year, right? So, you know, you can lock in positive territory, and you know that'll just give you a little bit of ammunition, depending on your circumstances. Okay. Okay. All right. So we have another question which is not in the live chat that I've been asked to take a look at. Oh. Okay, or maybe it was, but let's see here. Oh, yeah. Okay, so this is your question. So I asked this question but did not receive a response, so I'd like to restate it more fully here. On July 16th, 2025, MicroStrategy closed at 457.22. So let's just pull up a chart of that. A chart. At 457.22. That would have been right around July 16th. So I'm on the 17th, one day prior. Okay. Is this it? 7/16. Okay. Well, Bitcoin, IBIT, was 67.83. All right. And maybe I don't need to have quite that much. Let's just free up a little bit of space. Okay. There we are. By October 8th, all right, so that was last week, MicroStrategy had declined to 300 even as IBIT rose to 70. Okay, yeah, I see that. Given that MicroStrategy holds 193,000 Bitcoin, financed partly through debt, could you calculate the current value of its Bitcoin holdings, its outstanding debt obligations, and the resulting implied net asset value per share? What factors might explain why MicroStrategy trades at such a steep discount to its implied NAV? So that's an interesting one because actually MicroStrategy has not typically traded at a discount to the book value of the Bitcoin that it holds. I think that's kind of an important point. It is possible for us to take a look at this and do some comparisons. So let's do that. There was a legitimate reason why it didn't also, and that reason was that they had a mechanism to essentially make accretive trades that would give shareholders exposure to Bitcoin upside. So let's do this. And why don't we take a look at, this is the way we'll think about it. Now, let's bear in mind that strategy has an underpinning business. It's de minimis relative to what they are now. But they do have a business, and they had value before that. So understand that the exercise I'm about to go through is going to ignore all of that. All right? So, let me just come over. I just need to move some screens around so I have access to more than one thing here. So what we're going to do is we're actually going to look at the value of MicroStrategy X debt X cash. And then compare that to the Bitcoin. And then we'll just chart that as a ratio. There's probably a way to do this really quickly in here, but I'm gonna do it this way. Oops. Or supposedly I'm gonna do it this way. So we're gonna just take a look at a time series of the enterprise value. Now also, I'm not gonna be dealing with the changes in the Bitcoin held. I don't know that I have an easy way in an API to pull that out. Well, let's just go back. We'll go back 6 months. We'll go back to April 1st. How's that? So we will pull out the enterprise value. So that's X cash, X debt. And as you might guess, this is in millions. You know what? I can actually make that a little bit cleaner just so that everybody can sort of see what's happening. Yeah, I'll just multiply by a million here. All right, so this is the enterprise value of the business in this column. And why don't we get the US dollar Bitcoin cross for all of those same days. And we'll just take your number. And let's see, hang on, let's also just double check something. Just want to make sure, I want to see if I actually can get a time series of... So they've it's a much bigger number. Is what I'm seeing here. It hasn't grown that much since July, but it was actually closer to 600,000, not 193. Or were you just talking about net adds for the year? Because that's about what we're talking about, right? That must be what you meant. So the idea was that it was going to... I'm going to put the current amount of Bitcoin just for the sake of argument. Or you know what I could do? Let me see here. Let's go back to that for a second. So that was on April... So this was about 528,000. So it was about 528,000 to start. And we ended at... Looks like it was relatively linear. Yeah, why don't we... That's what we can do. That's what we'll do. So that's that. We'll just assume that it was just basically adding every day. It's not... I recognize that's not how it happened, but... All right, so here's what we're going to do. So we're going to say that's the Bitcoin price. We're going to say we started with 528,000, round numbers. Oh, yeah. Oh, that's a good point. So let's see. That's going to have to be... How many weekend days were in there? Let's see how many days this was. Yeah, hang on. Let's do this. Yeah, I'm going to do this. That's 135. So that's... Let's do go by trading days. 830. Okay. So now we're just going to assume it's linear. So this is going to be equal to that times that. And now we're going to take a look at the premium, which is going to be equal to... Well, we can look at it in two ways. We can look at it as a ratio, which I think is interesting. And this is what that ratio looks like. So that right there represents the multiple of the book value of strategy to Bitcoin throughout the year. And actually, in some ways, I'm going to format this axis to actually end at 1. And here's why. It really shouldn't go below that. Right? It should, at the very least, the company should trade to book value. So again, I've extracted all cash and debt. I'm discarding the value of the rest of its business because you could always just abandon that. And it should at the very least trade to book value. So at the moment, if you thought that there was nothing of value in the way they operate their business and their intent and their whatever creative financing they could get into, then you could say that on a relative to Bitcoin basis, it can go from where it is right now, which is, we'll call it, 38% premium. So that means that, you could lose about 27.5% of Strategy's value right now before it trades to essentially 1 times tangible book, if we think about it that way. And that clearly seems to be the trend. There's a reason why some of that premium would go away, though, and that is that part of their ability to do these accretive Bitcoin transactions was that they were able to harvest a lot of volatility out of Bitcoin itself. So, and the challenge there is that it isn't quite as volatile as it was. So, we'll get rid of the implied move for a moment. We're just going to look at realized. But that volatility has been trending downwards, as you can see here. And because they were capitalizing on that very high premium to help finance the accretive purchase of more Bitcoin, or synthetically at the very least getting exposure to things like synthetic call spreads. That's effectively what they were doing. The zero coupon bonds, as I've previously expanded, those were convertibles, and effectively they were selling 50% out of the money premium on their own stock to buy Bitcoin at spot. And as the volatility of Bitcoin goes down, then the strike of the convert would also decline. And so you just end up reducing the amount of incremental Bitcoin you can finance by doing that, either because you're giving away more of the upside in the convert strike, or because you're borrowing less money, or some combination of these. It's also one of the reasons why that ended up not being the way they continued to try to finance those purchases. So the question you have to ask yourself, if you're interested in strategy, is, am I prepared to take an incremental 27.5% downside risk to my capital relative to the downside risk I'm already taking on Bitcoin, on the hopes that Michael Saylor and the gang over at Strategy can once again find creative ways to play in this space that give me a benefit beyond just the Bitcoin that they hold? So is there some premium I'm willing to pay them above their tangible book value? I personally think there should be some premium. Is the 38% premium that they have right now, which again is, so just the way the math works, a 38% premium does not mean that it has to decline 38% before it gets to tangible book. It only has to decline by about 27.5%, as we've seen, for it to get to tangible book. But should it trade at some premium? I think it should. So I don't really think that 27.5% downside relative to Bitcoin is actually the real number. But I haven't seen this trend reverse yet. And this trend, one way to think about this trend is, to me, it's like a consumer confidence index of sorts on Saylor and Strategy. But it does have a terminal value, and the terminal value is 0. So it's not likely, I think, that most people are going to look at this and say, okay, well, at some point, MicroStrategy is somehow going to be worth less than the value of the Bitcoin that it holds. That doesn't seem to be. I don't think that's really the right way to think about it. So, at some point, I think it's probably worth, taking a look at this and saying, this is arguably a better way to play it to the upside. When it was 2x, I wasn't so sure about that. As it starts getting down, less than a 30% premium, everybody can sort of make their own determination about what they think the right number is. But the other thing I would also point out, so we just saw that this has been trending down, but I would also ask you to take a look at this. kind of feels like it's bottoming out, that sort of steady decline. My take on that. So hope that helps. All right. Let's see here. The SPY risk reversal you showed, collar, I mean, risk reversal, we often use a risk reversal to describe a short put, long call, and a collar to describe a long put, short call, which is what we were doing there. Would I consider a longer expiration date to protect the portfolio? Sure. I was just saying that it should probably go at least out into next year. Yeah, I generally think that that's a better way to play it. Just at the very least, from a tax perspective, don't force your hand. I mean, you can always close something early, but you can't hang on to it past expiration. So, and this is just a strict offset for one another. So, yes, you absolutely could go further out in time, and that could certainly be reasonable too if you're looking at the term structure. Because the further out in time, the higher the volatility is going to be if it's in a normal sort of contango. And indeed, that's true here. So you can say, okay, well, January, this is I'm going to get rid of this last week's. Obviously, vol's higher after what happened at the end of last week and the beginning of over the weekend and then this week. But, these are pretty chunky numbers, getting up in here. So, yes, you could certainly go further out in time if you chose. But also recognize that if you do that, then it's going to soften up the deltas, the gamma, of the options that you're long and short. So, the immediate impact won't be quite as profound necessarily. If you're just looking for that sort of payoff graphic that I was showing earlier. Okay. Beto, I like selling calls to protect my positions and make some extra income, but with this crazy market, I've been capping my profits. What kind of data should I check to pick the right strike? Yeah. So this is something that I've discussed before, and that is that, especially when rates were low, I thought that the upside delta of calls understated the probability. So one way that people like to think about the probability that something ends up in the money is by taking a look at the delta of the calls, which, strictly speaking, is a statistical measure of that likelihood. What do I mean? Well, let's just, since we're in SPY, why don't we just look at this? So you could use that as the approximate probability that an option will expire in the money. So let's just go out. We'll use the expiration that I was just talking about. And let's say that you wanted to sell a call option that had arguably a 20%-ish probability by the options market's reckoning that it would end up in the money. And that would be, in this case, it looks like it would be the 710s, January 710s. Those are a 19 delta. So using that math, you get to a 19% probability that that strike is in the money. 705 is 22, but you will notice that if you sell the 705s, you're collecting more than $5. So in the money is different than just saying, is it going to be profitable or not? So 705, 710s, you're looking at that probability. The thing is, though, that the market generally goes higher. As I've often said, over any 30-day period going back for a century, the S&P is up almost 60% of the time. Over a 3-month period, that probability is even higher. That's the general pattern. The forward prices will be higher because the dollar's being devalued. The expectation is that the underlying assets are growing, earnings are growing, revenues are growing. So equities should be expected to appreciate over the course of time. And the longer the window of time you look at, the greater that probability will be. There are not a lot of periods that one can look to say, okay, was the market higher or lower 10 years on? Now, some things, like the Nikkei, it took an awful long time for it to recover. And, the NASDAQ also took a long time to recover off of the tech bubble highs and the subsequent decline. So, to my thinking, I would agree that when it comes to selling upside covered calls, that the delta mechanism as a technique to establish the probability doesn't work so hot. The stuff that Carter and I have worked on together, often involving short strangles, so identifying levels where you'd be willing to get long the stock, identifying levels where you'd be happy to sell it, that, the same thing was bearing out there. That if anything, you want to bump up the call moneyness. Now, and there was a chart that I showed earlier, it was probably a couple weeks ago, where I was showing a longer term buy rate on MicroStrategy. And one of the things is that if you have steep contango in the volatility surface, so you're actually selling out of the money calls a little bit longer dated, further out of the money, but at a higher implied volatility, you can offset some of the risk a little bit of this, because not only are you selling a higher strike call relative to the current stock price, and you're kind of muting the noise that happens in the middle, but also you have two tailwinds now. One is theta, which is just the decay of an option's value over time, but the other is vega, because if it is going to generally be a volatility surface that is in contango, that vol is going to come in over the course of time, and that also provides a tailwind. Now, something like MicroStrategy could come in a ton. Now, that was aided by the fact that vol also on Bitcoin was falling. I will say that this is a strategy that tends to work better in spots like that, where you have a maturing stock or a maturing industry or some other thing like that going on. You see this all the time in IPOs. I did a study where someone had asked me to make predictions about what I thought would happen to the implied volatility of Facebook when it was still Facebook, very shortly after its IPO. And what I did was I took a look at all of the IPOs from, I think, the late 1990s on, and sort of made a melange of those, if you will, and just took a look at the pattern, from the day they IPO'd to 12 months later to 24 months later, and so on. So those types of issues tend to benefit the most, because implied volatility can be very high. You can have a lot of upside in some of those stocks and sell strikes that are considerably out of the money for the calls you sell because of that high vol. If you're dealing with a Procter & Gamble or a Kimberly-Clark or a Clorox or something like this, this isn't going to work out so hot for you, because those things can migrate a considerable amount over longer periods of time, but their day-to-day volatility is quite low. So that's kind of the balance you're looking to strike. I apologize if that's not a hard and fast answer, but unfortunately there is no hard and fast answer, because it's going to depend on these multiple factors, if you will. So I hope that helps you a bit. Isn't the break even, the 595, a break even? Oh, the break even of 590. Yeah, so that's probably 12. It could have been. I mean, let's see what do we got there. So 590-ish over 663, 11%, right? But bear in mind, there is. Let me just see what the schedule is here, because there's also some dividends that come in. So yeah, you're expecting another $1.98 dividend. And does the January expiration capture a dividend or not? Will this thing work? There we go. Let's see here. So there's one dividend in there. So it's really not quite 590. It's really 592 over 663. So it's 10.7. 10.7% break even, like that. Pretty close to 10%. Look, yeah, and again, this is going to go to whatever your way of thinking is. Are you looking for the possibility that there would be a correction before the end of the year? I've said many times, by the way, and I know all of you who've been watching for a while will remember this, that I said that if we can make it past the September FOMC to September 30th, that I thought we would be in pretty good shape. and that we would end the year higher than we were at the end of August, because this was a comment I was making pre-Labor Day. And that's because this is a seasonally strong time. There is a lot of cash that's on the sidelines. Some of that cash gets deployed. People get bonuses. That gets deployed. You know, it tends to, people get concerned about October and November, and it's true that they have above average volatility, but the reason is not because the market always rolls over in October and November. It's because on those instances where it did, volatility spiked by such a degree that it sort of threw the averages off. But that doesn't mean that there's a much higher probability of a decline. I would actually say that, you know, November and December are traditionally pretty good times to be long the market. So, all right, let's see here. Mike, what do you think on the ETF for the airlines like Jets or maybe AAL? You know, it's interesting. So in the airline space, well, let's look at this one first. I'm not sure whether you're talking on the long or the short side. I'm assuming you're talking on the long side, but in that space, I've gone back and forth between Delta and United as sort of the ones that I thought were the best of breed in there. There's a lot of names in there that I just felt really were kind of struggling to figure things out, not least of which was Love. They obviously were having significant operational snafus. They had some way overdue software upgrades, I understand. And also they have a rather unconventional system that appears, by my reckoning at least, to be much more fragile, because they've got planes taking off from one location, they go to another, drop some people off, and then continue on to another place, and so on. Whereas the big operators are, you know, they have major hubs, maybe one or two or three. You know, United obviously has the former Continental hub, so Houston was a big spot. San Francisco is a hub, and New York, Newark is a hub. So they have, you know, sort of traditional hub and spoke, and they can kind of work around things. American, same sort of story. Dallas, Chicago, so on. You know, outfits like Love were definitely in a slightly worse situation there. So the airlines have benefited from the fact that oil prices haven't experienced the same kind of inflation that other things have. Big part of their operating expense. They had a whole bunch of sort of contract negotiations that they had to deal with, as I'm sure many are aware, you know, with the unions, because that's really, when you think about it, there's really three key pillars, which is, number one, consumer confidence and spending. Are people actually traveling, and are businesses doing that? You know, for the major carriers, they have more exposure to that. For the Loves of the world, they're going to have, you know, the discount airlines, they have more of the personal travel kind of thing to worry about. So when you're thinking about their average revenue per seat mile, and then you are also thinking about what their margins are, those are the things that are going to drive it. Jet prices, whether or not they're having big labor issues or not, and whether they've sort of gotten to a place where they're happy with that. And then, you know, the consumer and business travel. In general, it's been pretty good, and these things trade pretty cheap. So let's take a look at United first. United's estimates for full year next year, $12.83. That represents 24% year-on-year growth, 7.6% revenue growth, 6.5% net income margins, which is, you know, as good as it's been. That matches the last 12 months, but that's as good as it's been over the course of the last 5 years. And at that price, it's trading at 7.7 times earnings. And Delta, which many consider to be best of breed, a lot of people like the fact that they were sort of thinking outside the box. They bought a refinery, some may or may not remember, several years ago, in an effort to basically have sort of more control over their situation. That one is trading at similar growth numbers, better margins, 8 times. So that's the good news. The bad news is the technicals are kind of a mixed bag here. So we're well below the 50 at this point. Looking at these technical indicators, and actually I just had the screen, so I'm going to bring it right back so we can get another look at it. So these are the best performing technical indicators over the course of the last year using daily data. And we can see that the moving average oscillator, that one's still bullish, but it's a pretty mixed bag. I mean, most of the better performing technical indicators here are otherwise fairly negative. We just actually booked flights for the holidays. I think we're flying Alaska. I don't remember what we're flying. I have to look at my confirmations, but for some reason I thought I saw something come up. Was that what it was? I don't really fly Alaska a whole lot. This is for, I'm usually looking for business travel, so can't really speak to that, but I do remember that the countdown was on, I think, let's see, where's that? Travel, your flight. Oh yeah. Alaska and Hawaiian. Okay. So on a valuation basis, I like it. I think those two in particular are operating well. Jets, because it captures some of these other ones that I think are kind of floundering around a bit, I'm less enthusiastic about. I kind of try to pick out the best of breed, and the numbers seem solid. But I do also feel that when I look at that chart, I don't really see these things breaking out to new highs right here and now. We're looking for a better level. Maybe the 200-day, which is down. If we're looking at jets, that's going to be. We're looking at like a 5% decline or something like that from here. And we can also, one other thing we can look at, which I think is worth just paying attention to, which is where these things are relative to their own historical multiples. So this one is delta. You can see that it's pretty much below on a fundamental basis all of its sort of historical multiples, and it's trading on or about the mean for the group. United also. And actually, I think we talked about this. There was a big divergence between United and Delta valuations several months ago. Maybe we can find it. But I vaguely remember having this conversation and then making the point that United had kind of caught up on the valuation gap relative to Delta. And so it wasn't necessarily as compelling as it had been before. As you can see, they're within spitting distance of one another. Similar top line and bottom line growth estimates. The Delta Airlines margins are a portion, one might assume, of the slight premium that it enjoys. But I would also suggest that that's also an opportunity for a competitor. Okay. All right. Yeah. So, okay, yes, we're getting an update on the MicroStrategy thing. Steve Garcia, hello from an overcast Marin County. Yes, I noticed that. There are some who believe that JD is prime for a catch-up trade. Take a look at the valuation here. What we have on the fundamental side. Here, I'm going to just convert this over. These are not dollars. So it's going to default to the local currency. So let's put this into dollars so we can look at the ADR more intelligently. Sure is cheap, isn't it? is this support down here? That's really, I think, the question we have to ask ourselves. Man, it looked like it was good. It looked like it was into a bearish to bullish reversal. But that does not seem to have held. Then we got into that death cross back in the middle of the year. You know, this might be a good one. This might be a good one to ask Carter about when we have him on day after tomorrow. I mean, there's two things going on here. One, do I like any situation where you have an opportunity to buy a growing company in a decent space at a high single-digit multiple? And the answer is yes. But there were plenty of chances over the course of the last 30 months or more where I could have said the exact same thing about it, and that would have been a very painful ride. So to me, really this is more about whether the money flows support that than it is about whether or not the fundamentals support it. Fundamentals, I do believe, supports it. And, you know, you're kind of maybe backstopped by these recent lows, but that's a good ways down. I mean, that's a third. The stock, to get to the lows that the stock had in early 24, you know, that's 30% of its value. So, and it looks like it has broken through every sort of meaningful level of support here. On the other hand, let's see what how expensive are the options. Ooh. So this might be interesting. So 50%, I'm just looking at the implieds. That's going to be the lines in white. 50% implied 3-month vol. So to dip one's toe in the water, let's see what happens here. Where's my... Now we can start looking and saying, all right, well, I don't know exactly where this is going to work. And, you know, again, recognizing that, you know, this is not a, I mean, options play, as we can see here, also not recognizing this as a bullish pattern. But, you know, if you were going to, let's say, buy a little bit of stock. So let's just modify this thing. And let's say that we bought, oops, didn't mean to do that. Bought some stock. Maybe about 50 shares worth of it. With an idea that it could buy a little bit more against it. Let's see what we can do here. I want that to be a call. Just skew that up a little bit. Let's get that out. Go. I might be inclined to do something along these lines. So that goes there. Strike is that. Go even a little higher. And let's go down here. It's something that looks a little bit like that. Just because the vol is pretty juicy. So the upside break even on a trade like this, which is going to get a decent standstill rate of return, I mean, is, you know, it's way up there. I mean, we're talking about $56. And I think that might be a way to play something like this. Not a big outlay either. I mean, we're talking about 50 shares. Okay, 50 shares and a one-lot strangle is sort of like a single unit of this trade is the way I'm kind of thinking about it. So that's $1,662 worth of stock per unit. And taking a decent bit of premium. I think that might be a way to play this. But again, if you want to wait until we get somebody whose technical analysis skills are more concrete than my own, I do think there's a little bit of a backstop on the valuation side. I mean, it is cheap. So, and there's really just this international overhang. Keep your eye on Truth Social, I guess. So I have to make a point of that. I really should log on to this every single day. And I've logged on to it, I think, 3 times in my life. I've logged on to Truth Social, but I just, sort of responsibility demands it. He moves markets. You can't ignore it. So there we go. Goldman Sachs earnings. I'm actually taking these things a little bit out of order, but let's just take a look at Goldman Sachs here, just because I happen to see that one, and you're asking about the technicals. Let's just ask Bloomberg about the technicals first, and then we'll take a look at the charts and see whether we agree. Generally speaking, this is mostly positive. All of the better performing indicators are. Stocks up strongly today. Not expensive. By the way, this is something else I should say, which is that, financials doing well going into these prints, that's a positive for equities generally, because it's rare that you get a circumstance where financials are killing it and equities overall are declining. That's just not. And also, it's going to be very difficult for equities to do well if financials are rolling over, because as we often talk about, a lot of equity market declines are precipitated by credit events, and the credit events are typically going to hit the financials first. So, in terms of implied moves for Goldman, oops, what happened here? Oh, I'm sorry, I moved over to XLF first. 4.2% implied move, 2.2% is the average. And what are we looking at here? I mean, this all looks pretty decent. I would actually look to JP Morgan because that's kind of a blend of the investment banking side and commercial and consumer. So this thing's trading 15 times. It's behaving pretty well today, I would say. So yeah, I think we can stay in these. That's my 2 cents for that. Holy smokes, did I go over an hour already? Look at that. Joe came in pointing out options play shows the delta next to the strikes. That is true, and I want to make this point really quickly. So hopefully we can see this. I'm going to look at the screens that you guys see. So if you're looking over here at this line that I'm highlighting, the number on the left is the strike, 42.5. The number in the middle is the price. And actually, let me just do this. We'll go in the middle. So this is the mid-market price. That's going to be the bid, I assume. We'll go like this. And that's the ask. See? So if I put buy, it's going to assume you're going to pay the offer. So that's $1.20. Put sell. Shows $1.09. That's the bid. 115 is the mid price. But over here, over on the right, is the delta. So that's a 24 delta. How much is the $1.10 option, $1.15 option going to move if JD rises by $1? 24 cents. So that's the delta. And that's a very good point. Joseph Kamen, thank you for making it. That if you happen to be using this or any system that does so similarly, that you can see essentially what that earlier approach, which I have indicated has its own flaws, that you can use the delta to say, okay, well, this is the options market's approximation that this option expires in the money. Remember, though, that in my experience, because of skew, this was aggravated by the interest rate dynamics that we had when we had the ZIRP policy, that I believe that delta understates it on the call side and overstates it on the put side. So I would kind of use that to adjust your strikes accordingly. So if you're going to say, all right, well, I want to sell a 20 delta strangle, I might actually sell a 24 delta put and a 17 delta call instead and lean a little longer, just because, as I've often said, the general trend is that stocks are higher. Okay. And let's see, is there anything else I want to grab? Yeah, so Michael Anthony, you stepped away with respect to Jets and AAL. All I was saying is that I think that, yeah, you can watch the replay. I like Delta and United better than I like American. But admittedly, well, first of all, I prefer to fly those two airlines. Secondly, I had a lot to do and deal with when I was at CRT with the American Airlines bankruptcy many years ago. Very interesting trade, by the way, because the way they structured that deal when they merged with US Air was that the equity. If you want to see an interesting deal structure, I would encourage anybody to go back and read that one. It was really very interesting. So American had both an operating company and a holding company. They had what were called single and double dip claims. So this was debt that was issued either by the holding company or the operating company, and the debt was basically on the full faith and credit of one or the other or both. So if it was one, single dip. If it was both, double dip. And when they merged with US Air, the company was operating in bankruptcy. The company had filed for bankruptcy. The stock was trading for 50 cents a share or thereabouts. And in order to get shareholder approval for the deal, basically what they said was, well, we will give AMR common shareholders options on NewCo shares. And basically, all of the debt was going to be repaid by equity of NewCo shares. So if US Air stock took off, pardon the pun, since we're dealing with an airline, then that could satisfy all of those claims. And so basically, you were watching US Air stock really closely. And what ended up happening was it did take off. All of those claims were satisfied. And these Asian, there was 4 tranches of Asian options. Asian just means that it's actually calculated based on the average price of the underlying over a period of time rather than a price at a specific time. And AMR was basically this tranche of Asian options, and that stock went from 50 cents to $17 in a very short period of time. 34-bagger. A really interesting deal. And I was involved with that partially because we had some really, really good credit analysts at CRT. Credit Research and Trading was the name of the shop, and as the name implied, I'm not going to take credit for the wonderful work that those analysts did, but we had 5 people who were tearing apart American Airlines, and they knew every single asset that company held. I mean, they had the serial numbers on the tugs at the gates. So, anyway, I think I've chewed up enough of your time for today. Hopefully we have office hours tomorrow. I have no reason to believe we won't. So you can join me and Mark Guthner for that. And then on Wednesday, an exciting open mic because I'm going to be joined by my good close friend and colleague Carter Worth. And he'll take some of your questions and talk about some of his sort of philosophy about things. And Michael Anthony's asking, when was this? So the American Airlines bankruptcy, if memory serves, that was 2012. You guys can double check that, but I believe it was 2012. And it was either mid-late 2012 or early 2013, but I'm pretty sure it was mid-late 2012. That's when the AMR bankruptcy was. Very interesting deal. And with respect to Jets, Michael Anthony, I'm just saying I prefer United and Delta. I'll leave it at that. So all of you, thank you very much for tuning in. Like, subscribe. Your comments are welcome. As you can see, we get to them when we can. So keep those coming, and we'll see you here tomorrow. Thanks for watching.